Logan and Warsco. I'd like to welcome you to our webinar on the 2017 Tax Reform and Jobs Act. We have a good participation today, and so there's a lot of interest in this topic, which is understandable. We have three presenters. It's going to be Cindy Wolfer, and then it's myself and Alex Platty of our office. I'm going to be talking later on the corporate business provisions and especially and also the compensation and benefits that affect corporations. Alex is going to talk about the pass-through entities such as S corporations, partnerships, LLCs, and the like, and the tax provisions that affect those in the Act. And Cindy Wolfer will do individual tax rates, tax provisions, and the effect on estate, gifts, and trusts of the Tax Act. We're going to take just maybe one or two questions from in each area after each presenter talks, approximately. So we're trying to keep this to an hour is the design of the webinar, not to take up too much of your valuable day. So on the upper right side of your screens, there should be an area which you can submit questions if you would like during each of the three presentations. But again, we have a design for 1 hour, so we may be limited in the number of questions we can take. One general comment before we start is this act is very new and there needs to be a lot of regulations, and the IRS is going to be very busy in the next few months providing some clarity as to some of these tax issues. So so there may not be a good answer to some of your questions that you might have. So there's a lot to get through in this hour, and again, we want to try to keep it as close to an hour as we can. So with no further ado, I'm going to turn it over to Cindy.
Thank you, Denny, and good morning, everyone. Thank you for joining us today. I will spend the next 15 minutes or so reviewing changes in the tax law affecting individual taxpayers. Importantly, the particular changes with respect to individual taxpayers are not permanent and principally only affect the tax years during an 8-year period beginning this year in 2018 through a period ending December 31, 2025. And I refer to this period sometimes during my talk and on the slides as a modified period. There is one important exception, and this relates to how amounts, thresholds, limitations, etc., are indexed for inflation in the future. The indexing has been permanently changed to be adjusting inflation using what's referred to as a chain CPI. And the effect of this new indexing factor will cause amounts indexed for inflation to rise more slowly in the future than they have in the past, which by itself will likely have the effect of causing increased future tax liability without there actually being increased future any changes in tax law. And I also want to note that not everything that was originally in the House bill that was widely publicized in the media was part of the Senate bill. When the bills were originally approved by each the House and Senate, they went into reconciliation, and the Senate version tended to prevail. So if you've heard of changes, you may have heard of changes, but that may not have ended up in the final bill. But overall, the next few slides will summarize what we believe have the most effect on most individual taxpayers. A broad generalization of this will be that individual taxpayers will overall see a slightly lower income tax rate due to lower tax rates and the doubling of the standard deduction. Importantly, each taxpayer needs to run the numbers for their own particular situation. A Wall Street Journal article last week reported that according to the Tax Policy Center, about 11% of households will itemize under the new law, which is down from 26% under the prior law. individual taxpayers can still itemize, but because the standard deduction is doubled, less individuals will do so. So let's go through some of these changes. The individual tax rates are dropped from the highest rate of 39.6 to 37. And there's now 7 categories, 10, 12, 22, 24, 32, 35, 37, rather than the 4 brackets that were in the original House bill, but a tax software can easily calculate the liability. The personal exemptions are eliminated, but the standard deduction nearly doubled. But there was some important exceptions about the eliminating of the personal exemptions. There's an additional deduction allowed for the aged 65 and older and the blind that is still available in 28 and through the modified period. In the standard deduction, the amounts showing on the file, on the slide, excuse me, those will be indexed for inflation beginning after 2018. There's a child tax credit for families with children under age 17, there's a $2,000 tax credit per child each year. And a portion of this, approximately $1,400, is refundable if the taxpayer has no income tax liability. And the amounts causing phase out begin at $400,000 of income. So more families will benefit from the child credit than they could in the past. For dependent children, 17 years of age and older, the credit is limited to $500. And that new credit is not as valuable as the former personal exemption of $4,050 for a taxpayer in the 25% tax bracket, because they would have gotten approximately $1,000 tax benefit from that personal exemption that was eliminated. So basically their benefit of a child 17 and older is cut in half. Families with dependent children 17 and older will likely see some increases as a result of that, unless they have some additional, maybe like education expenses. And I'd like to stop here and just talk for a second about the new withholding tables that the IRS issued a few weeks ago for employers to use for wages in 2018. I ran the calculations on my own income and projected it for 2018 and found that my withholding based on the W-4 I had on file was about 10% lower than what I expected my tax liability to be. And while I don't like to make a tax-free loan to the government, I do like to make sure that I'm not hit with surprises at the end of the year. So I would urge everyone to do an estimate. I think with the new tax law, with it being simplified, it may be easier for you to do that. But you try to run through those numbers or with your CPA or with the tax software. Going on, the kiddie tax has been simplified. Now for an underage 14-year-old dependent child with earned income and capital gains is taxed at the trust and estate rates rather than looking at the parents' rates. The trust and estates have compressed tables with higher tax rates at lower levels of income. Alimony was significantly changed for new or modified agreements after 2018. Under prior law, the alimony was deductible by the payor and included in the income of the recipient. That has been reversed. It's no longer deductible by the payor for the new agreements or modified agreements after this year, nor is it included in the income of the recipient. I figure that the government must have figured out that the payor is perhaps in a higher tax bracket than the person receiving the funds. Alternative minimum tax, referred to as AMT, was not repealed, unfortunately, but it will apply to fewer taxpayers during the modified period due to increased exemptions and thresholds. And then the healthcare law mandate is eliminated beginning in 2019. Roth conversions. When a taxpayer converts a traditional IRA to a Roth, previously the conversion could be recharacterized by the due date of the taxpayer's tax return for the year of the conversion. So if somebody made a conversion in December and extended their income tax return to October 15th, they would have until October 15th to decide if they wanted to undo that. Because when you make the conversion from a traditional to a Roth, you pay ordinary income taxes on the amount converted. And if the market tanked and the investment that got converted went down, taxpayers didn't want to pay taxes on the higher amount and would undo it. After end of last year, that option is no longer available. And then there's an important deduction, the qualified business income deduction. It's significant but complicated and available for certain flow-through business income. And Alex will discuss an overview of this after my section is finished. And then there were some modifications to itemized deductions. So again, the standard deduction was basically doubled, but there was some significant cutbacks on deductible itemized deductions. State and local tax deduction is limited to $10,000 per taxpayer. And that $10,000 deduction is limited, is for a single taxpayer, and it's also $10,000 for a married couple. If a married couple files separately, it's only $5,000. So here's a marriage penalty. The other, what I think is significant change is that there's no longer interest on a home equity loans are no longer deductible as mortgage interest. And there's elimination of the miscellaneous itemized deductions, including the expenses of being an employee. On the slide, I show the healthcare expenses. Actually, they originally talked about completely eliminating those. I think it was in the reconciliation committee where it ended up for 2017 being this tax year, and for 2018, I'm sorry, I said this year, but last year for this tax filing season, and for 2018, it's actually more generous. So you can only deduct the amounts in last year and this year to the extent they exceed 7.5% of your AGI. And after that, during the modified period, it'll be expenses that exceed 10% of your AGI. So planning, what can individuals do to, I'm sorry, I'm going to finish. I just flipped to a slide. Talked about eliminating miscellaneous itemized deductions. The next bullet on gifts to charities, that's really, the formatting is not correct, but what that's intended on, the itemized deductions, cash gifts to public charities was actually made more generous. So it's now going from 50 to 60% of AGI that's deductible. And then the other thing that was changed is there were PEAS limitations that cut back itemized deductions for high income earners, and those were eliminated. So planning ideas, what can you do with the change in doubling the standard deduction? And like I said, 11% people are going to expected to itemize going forward during this modified period. For people that are charitably inclined, they can bunch their charitable deductions in 1 year. And so you could, in 1 year, give a lot to your favorite charity, and the next year maybe not give anything. And so it's kind of a feast or famine for public charities. A lot of people don't like to do that because they're supporting their public charity, including their church. So what they can do instead is by bunching, make a donation to a donor advised fund. And there's banks in town that offer donor advised funds. There is the Fort Wayne Community Foundation that offers donor advised funds. And you can also call an 800 number and talk to someone at Fidelity, Vanguard, Schwab. They offer donor advised funds. And basically when you put the money into the fund, you are, it can no longer, you can direct where it gets paid. It can only be directed to a qualified charity. So in 1 year you could make the contribution, and then the following year you can direct that fund to pay those some of those funds to your favorite charity. Each of the funds, you should check with the custodian, have different limitations on what it takes to create a fund. There's different limitations on the minimum amount you can distribute to the charity. So you should look into that. The other thing that a person who is 70 and a half or older and who has a traditional IRA, a few years ago they made permanent the distribution from a traditional IRA to public charity, and the treatment is it's not included in your taxable income and you're not entitled to an itemized deduction. But in this case, it also doesn't affect the amount of your standard deduction. So you can make gifts with your traditional IRA if you qualify. And I'm not going to get it. You can also make gifts with stocks and stuff, but I'm not getting into that because it's not real, but that's really different than what we're talking about here. And then on the unreimbursed employee expenses, I'm just familiar with some situations where employee may travel for the business and not get reimbursed for that because it's included in a certain kind of compensation scale. If that's the situation, I think employees should sit down and review that and see if there's a way you can restructure it, because the employee is not going to be able to deduct those as an employee expense during the modified period. It's very difficult to go from employee to independent contractor. If that is a desire, you should sit down and talk to an employment lawyer. On 529 plans, this is an important area. The change allows a distribution up to $10,000 each year per student for elementary and high school education, and it's counted as a qualified higher education expense. There's also a distribution now permitted of up to $15,000 per year that can be rolled into an ABLE account for the same beneficiary or member of the same family. We're not going to get into the ABLE accounts, but basically those are accounts that are similar to 529 plans that are established for a disabled individual. I talk about the planning consideration at the very end, bottom of the slide. Want to highlight a contribution to an Indiana College Choice Plan up to a $5,000 contribution per year is eligible for a 20% Indiana credit. So on a $5,000 contribution, a taxpayer can get a $1,000 credit on their Indiana taxes. But it's not clear right now that these changes in the 529 plan are permitted distributions for Indiana income taxes. So before people start funding 529 plans and distributing the money out for elementary and high school education or transferring it to an ABLE account, they should confirm. And I think what I understand right now is we need to get some action by the Indiana legislators to either clarify or confirm that the credit or that those kinds of new distributions that are permitted will count for the Indiana credit. My last topic is going to be on the estate, gift, and generation skipping taxes. The principal highlight that and I'm just going to collectively refer to this as estate tax, is that it wasn't eliminated. They didn't do away with the death taxes, but the exemption was nearly doubled to an expected exemption amount of $11,180,000 per person in 2018, although the indexed amount is not yet confirmed by the IRS based on the new indexing factor. Otherwise, all the other rules that we were familiar with still apply. The estate or gift tax still remains at 40% for taxable estates over the exemption amount. There's still a portability of unused exemptions to the surviving spouse, but still need to file a federal estate tax return. And we still have the stepped-up basis at death for qualifying property. The annual exclusion gift for 2015 is $15,000, and the IRS has confirmed that. It'll be indexed in the future, but again, it'll probably be raised less quickly than it was in the past. I've already talked about the stepped-up basis at death and the portability. The last bullet on this slide talks about what we're going to refer to as the cliff. So in 2025, it's estimated that the indexed estate tax exemption will be $12,840,000 on December 31, 2025. And the next day, January 1, 2026, under the way the law is currently, that exemption is going to drop to approximately $6,370,000. So it's more than a 50% drop. I can't give you exact amounts because these amounts are going to be based on inflation and indexing, which we don't, of course, know. And also I want to keep in mind that these changes are only for 8 years, and specifics of each person's estate plan should be reviewed with a wealth manager, estate planning professional, because everybody's personal situation is different. All plans with formulas should be reviewed to see how the significantly raised exemption affects the planning, what's in place, especially for documents that were drafted in the 1990s and early 2000s. Does one rely on portability with a simple I love you will? I love you will. I give everything to my spouse, and if my spouse doesn't survive me, I give everything in equal shares to my children. There's a continued concern about, second marriages, management of wealth, and influence of children and others on a surviving spouse or his or her estate. And I think for those concerns can actually be greater than any tax liability that used to be incurred. And I think people should look at professional wealth advisors. There's significant flexibility that an independent trustee has over family member trustees. And then, so trusts, I think, are still important for those considerations. What can you do before 2026? Planning, I don't view death as a planning option, but you can make taxable gifts completed gifts before 2026 to take advantage of this higher exemption. And I've got a few things listed on this slide. There's a thing called a spousal limited access trust, where each spouse sets up trusts for the other spouse, makes a completed gift, uses their exemption. There's asset protection trusts available for individual single taxpayers. And then consider GST gifts to new or existing trusts for future generations. Other things that can be done, and I want to highlight here that when we talk about reviewing credit trusts to see if there's ways that they can be terminated and get a stepped up basis on that property at the surviving spouse's death. And there's some old credit shelter trusts that are out there. The trustee is restrained by the terms of the trust and whether or not it was contemplated that it could be terminated. So it's a very review intensive situation to determine if that's a planning option. The things that I mentioned before of wealth considerations, of asset management, undue influence on others still apply. So terminating a trust would eliminate those protections that obviously had some factor in the settlor creating the trust. So that would all have to be considered. There's upstream gifts of property that, let's say you have a parent and they're a lot older than you are, and you want to give you have low basis asset, give it to the parent. There's some limitations on doing that, but it can be done. But again, it's specific to the situation. It's specific on, there's some limitations if it comes back to you within a certain amount of time. Once you make a gift, the person receiving the gift can dispose of that property the way they see fit, so you lose control. And this period only lasts for eight years, so it just may not be available. But I'm just saying it's something that could be considered. There's ways to trigger completed gifts of existing marital trust. Again, it gets back to the terms of the trust and what's permitted. And then, the last bullet, all these ideas should be carefully reviewed with your estate planning advisor. It's fact-specific review. Wealth planners and wealth managers can also review those things. And I'm done.
Thanks, Cindy. This is Alex Platty. I'm going to be talking next about pass-through business entities. As far as questions from all of the individual and estate planning material that Cindy has covered, I don't think we've received questions just yet in our system. Please feel free to ask questions in the webinar software at any time, and we will hopefully be able to address some of those at least by the end of the presentation as they come up. So please don't hold off from that. Today I'm going to be talking about something Cindy mentioned, which is especially what's called a qualified business income deduction. All of the changes I'm going to be talking about apply to pass-through entities such as S corporations, partnerships, LLCs that have elected partnership tax treatment, sole proprietorships. I might slip into referring to all of these just as partnerships, as the Internal Revenue Code sometimes does, but I'm really referring to all of these types of organizations. So the big things that's been introduced is this qualified business income, or QBI, deduction. Essentially what's going on is that individual taxpayers who have this pass-through QBI from a partnership or S Corp, etc., may deduct the lesser of the total QBI they've received, or 20% of the taxpayer's overall taxable income. So this QBI includes most income from an active partnership. It does have some exclusions. It excludes wages and guaranteed payments made by the company to the taxpayer who's deducting. And that makes sense, because if I'm paid a wage, it's really my income, not the business's. So QBI excludes those. It also excludes dividends and investment income of the business. So really it's targeted at kind of active income of the business. This 20% deduction is available to trusts and estates. It's available to certain cooperatives under special rules, and it's also available for a portion of REIT dividends. This is a below-the-line deduction, meaning instead of a deduction from the taxpayer's adjusted gross income, it's a deduction from the taxpayer's taxable income. So this wouldn't, for example, reduce your tax bracket. However, it is available whether or not you take the standard deduction or you itemize. So it's in addition to the standard deduction. It doesn't say it on the slide, but to borrow Cindy's term of modified period, this deduction is only available through the modified period through 2025. So it will sunset after that. A couple of big limitations on this QBI deduction are tied to a specific income threshold. So these restrictions only apply to taxpayers with income exceeding $157,500 for an individual, or $315,000 for married filing jointly. That's not a hard cap. It's phased in for $50,000 above that for individuals, or $100,000 above that for married filers. So for those folks, two limitations. One is certain service businesses, including health, law, accounting, actuarial sciences, performing arts, consulting, brokerage services, financial services, etc. And the language that's used beyond specific service industries is any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners. So that's fairly broad. Interestingly, engineering and architectural services are not included within this this listing of service businesses. Those were in the original draft of the bill, but they were eliminated in committee. We in law were not so fortunate. So income from any of these businesses for taxpayers above the threshold is non-deductible. The other limitation on the deduction is a percentage limitation. The deduction is limited to the greater of 50% of the W-2 wages paid by the pass-through entity, or 25% of the W-2 wages paid by the entity, plus 2.5% of the basis of the entity's qualified property. So let's unpack this for a minute, see what this means. W-2 wages, fairly straightforward. The W-2 wages paid by the entity are the sum of the wages subject to wage withholding or elective deferrals or deferred compensation paid by the entity during the taxable year. So basically wages. So the deduction, a taxpayer, again, above the income threshold is only able to deduct up to 50% of the W-2 wages paid by the entity. The other limitation has to do with qualified property, which is generally tangible property subject to depreciation held by the pass-through entity used in the production of QBI. So this was added late in the game to basically address real estate holding companies with significant capital investments but few employees. So going back to the previous slide for just a moment, at the bottom, we see that the second part of this limitation is 25% of the W-2 wages paid by the partnership plus 2.5% of the basis of the entity's qualified property. So we note that if an entity doesn't pay much in W-2 wages and doesn't have qualified property, there's just not going to be a deduction available to taxpayers that hit the income threshold for QBI from those entities. So in terms of planning around the QBI deduction, as Cindy and Denny have both kind of alluded to, there's a lot of regulations that are still to come that will give us more detail about some of these definitions. Exactly what constitutes QBI, W-2 wages, qualified property, what may or may not be those service industries subject to the limitations on the deduction. But we can say a few things. Business owners listening probably are already processing in their minds the balance here between W-2 wages paid and these income thresholds. Commentators have said that the income thresholds for these deductions were decreased late in the game to try to avoid high income persons kind of gaming the system between wages and distributions from the company. However, if these thresholds are, in the range where they may or may not impact you, you could look at planning strategies to properly adjust distributions, perhaps make wage adjustments so that these income thresholds would be favorable to you and you could claim the 20% deduction. Another basic topic which is laid out in the slide, as Denny will talk about in a few minutes, the corporate tax rates have been substantially reduced. And it's possible that some businesses might evaluate once again their election between being treated as under the corporate tax regime or the as an S corp or the partnership tax regime. I think the moral of the story with respect to that is going to be wait and see. That may be something that businesses, especially with pass-through entities that distribute only a small portion of profits, there may be some benefit to evaluating that, but there are also significant things on the other side to take into consideration. Accumulated earnings taxes, penalties for undistributed passive income, how the tax consequences of a sale that may be contemplated in the near future. Also, if a corporation surrenders its S-Corp status, it can't reapply for S-Corp status for 5 years. So it's not a decision to be taken lightly. These are all things that obviously you'll want to review with your advisors, including accountants and your corporate planners. So beyond that big QBI deduction, we wanted to talk about a few other things involving transfers of partnership interests. These won't hit everybody, but there are some changes. Carried interest provisions, basically for partnerships in service businesses under previous law, and I guess existing law as well, to some extent, in order, when you transfer a partnership interest, in order for gains from that transfer to be taxed at long-term capital gains rate rather than short-term ordinary income rates, there's a 1-year holding period. With the new law, for certain service industries, including basically investment services or businesses which consist of engaging in capital market transactions or other specified investments, that holding period has expanded to 3 years that an interest must be held without incurring long-term, or in order to have the favorable long-term taxable rate. Another change involves a substantial business loss. Basically, when a transfer of an interest in a partnership occurs, the partnership is required to make some adjustments to basis to account for the difference between the recipient's proportionate share of the adjusted basis of the partnership property and that recipient partner's basis in its own partnership asset interest. These adjustments are required on transfer if the partnership has made the election to do so under Section 754, or if after this transfer has taken effect, the partnership's adjusted basis in its property exceeds the fair market value of the property by at least $250,000. This is called a substantial business loss. The new law increases or expands the definition of substantial business loss. Now, in addition to the previous definition, if the recipient of an interest in the partnership at the moment that they become a partner, if the partnership sold all of its property, hypothetically, and the new partner would be allocated at least a $250,000 loss from that transaction, that's considered now a substantial business loss that requires this adjustment to the partnership basis in its property. The third thing is, and this could apply to smaller or larger transactions, so we wanted to throw it out there. The transferee of a partnership interest is required to withhold 10% of any gain realized on the transfer. And this essentially has to do with the government trying to make sure that any foreign persons involved with a partnership are properly treating U.S. partnership income as subject to U.S. tax law. That may impact relatively few of our clients. However, the 10% withholding that flows from it is a requirement. You can get around the 10% withholding with a certain affidavit that we can also that we could help you with if you're facing that situation. but we wanted to mention it. A couple of other things to mention. And under prior law, if a partnership transferred at least 50% of its total equity within a 12-month period, it could be subject to what's called a technical termination. This could cause kind of some administrative headaches. The partnership's taxable year would close, partnership level elections would cease, partnership depreciation recovery periods would restart, and that's been done away with. There's no longer a technical termination of a partnership, so that should free up transfers of partnership interests to some extent. Another issue is from ongoing operation of the business, there's now kind of a cap on loss. So if a partner is allocated loss that exceeds that individual's adjusted gross income by $250,000, or for married filing jointly, $500,000, that excess loss may not be recognized. So that's a limitation. However, that loss can be treated as part of the organization's net operating loss and carried forward to the following taxable year according to NOL rules. So it's not necessarily completely non-deductible, but it's non-deductible non-recognizable in the current year. This restriction only applies through the modified period ending in 2025. It's not on my slide, but we saw that we have quite a few of our trust friends listening in today, and I wanted to mention a couple of other things with respect to electing small business trusts. So ESBTs are eligible S corporation shareholders. They've made a couple of changes there. Now a non-resident alien can be a beneficiary of an electing small business trust. And another change that's been made is that whereas before ESBTs could make charitable contributions under rules applicable to trusts, which is essentially unlimited, ESBTs that do in fact hold S Corp equity are now subject to the charitable contribution rules applicable to individuals. So in terms of percentage limitations that Cindy talked about a little bit earlier and carry forward provisions, ESBTs are essentially treated as individuals for charitable contribution purposes, and that could come into play. That is all of the content that I have for right now. I'm going to let Denny get started. I see we have a few questions regarding these pass-through taxes, and we'll be taking a look at those, and hopefully we'll be able to get to some of them in a few minutes.
Thank you, Alex. And now the corporate and business provisions I'll go through. I tried to hit the highlights. There are a lot of special small items, but I tried to limit in this presentation the highlights of the big things that affect corporate and business. And generally, I'd say that there's never been a better time probably to invest under the tax code. And that's a lot of what these provisions are, is reducing the tax rate, giving businesses more money, and then encourage them to plow that money back into the business and buy equipment and produce. So to start, the first item here, as Cindy mentioned, the individual alderman tax is still around, but they got rid of it for the corporations, which is good. So no more corporate AMT. If you are a corporation and you have paid AMT and you're entitled to a future credit to use that alternative min tax that you paid in prior years, you're allowed to carry that forward, but only for 4 years. So just keep that in mind. You have to use it or lose it in the next 4 calendar years. The next item is the big thing, that the corporate tax rate has been reduced to a flat 21%. Much talked about. I'm sure that's no surprise to anybody. And you know, the thinking behind that is it makes the American corporations a lot more competitive now. So also there's no net capital gains tax for corporations, a separate tax rate for that. That's obsolete. Because the tax rate has been reduced, they've also reduced the dividends received deduction. So if you're a corporation receiving dividends and you used to get a 70% deduction, it's now 50%. And the 80% deduction you used to get in a corporation for dividends received from an affiliated entity is now down to 65% deduction. So when you do the math, because the corporate tax rate is flat 21%, and that's been decreased, you're really not. This is really not a thing that hurts your tax rate. Now I want to talk about some accounting reforms that again may help you decrease your taxes. Corporations are now allowed to use the cash method. Now there's a common theme here in the corporate area too, is that they define small businesses as $25 million or less in gross receipts over the past 3 years. But basically, so if you have less than $25 million, you can use the cash method of accounting, and you're going to see that as I go through my presentation and talk about small businesses. Or small corporations, small businesses, I mean less than $25 million in gross receipts. So that helps you expense-wise, and also may ease some accounting burdens and get you out of the accrual method. So you may want to consider an accounting change there. Many of you in this, what they define as small businesses. Also, inventories are made easier to expense, again, for the small businesses. That's the second bullet point there. And also there's these, what they call the UNICAP rules about what you have to capitalize instead of being able to expense. For small taxpayers, they allow more of those expenses to be written off now. So you need to really get with your accountant, you probably read about some corporations saying, hey, my effective tax rate is going to be even below 21%. Well, this is some of the reason why is that you're going to be able to have increased expenses from what you used to have comparatively. The next slide. Should be, oh, there we go, long-term contracts. For a lot of businesses that have long-term contracts, especially contractors building buildings, are now allowed to defer income. And again, this applies to small corporations and businesses. You also can have a temporary, in businesses, you can have a temporary 100% expensing of certain business assets, or what they call bonus depreciation. And that's up until December 31st, 2022. After that time period, there's generally a 20% reduction in that till it phases out. So after December of 2022, the bonus depreciation is going to go down from 100% to 80%, and then the next year 60%, and so on. And then it's going to be phased out. So you know, when you're talking about a business that you're thinking about expanding over the next few years, talk to your CPA for planning purposes and say, you know, when's the best opportunity to do this so I get the best expensing. And you also want to time it with your income, when your income's coming in, because you want you want to be able to use these expenses, and so you want to have income in the corporation to be able to use these expenses again. So it's a timing issue that you need to think about and plan. The next item is luxury automobile expenses. This is now more generous. They've increased the amount of for passenger vehicles, how much you can depreciate in each year. And it about doubles it over the next the first 4 or 5 years, or the first 4 years of having a luxury automobile. You can make about double the expense that you used to. So year one, it's now $10,000. Year two, you can take up to $16,000 of it depreciation. Year three, $9,600, and year four and thereafter, $5,760. So that in 4 years, that's over $41,000 in depreciation expense you can take on luxury passenger autos. Also, the second bullet point on the slide there, depreciation deductions now for real property and residential real property are more favorable. The write-off period oftentimes can be over a slightly shorter term. Next thing, there is now a limitation on business interest expense deductions that corporations can take. It's now limited to 30% of your adjusted taxable income, plus any business interest income you have, plus any floor financing interest that you might have in your business. So basically, the first thing you look at is, generally you're going to look at, for planning purposes, say what's 30% of our adjusted taxable income. That's the most interest expense you can have. So you may lose a deduction here, and I guess that's kind of a trade-off for getting the 21% tax rate. Important note here is that the small businesses we talked about, again under $25 million in receipts, are exempt from this rule. The previous deduction for income attributable to domestic production activities is now repealed. You know, I don't want to go into too much detail on that other than just mention it here in the slide. It may or may not affect that. You used to get like a 9%, I think, deduction or something if you were sending goods overseas and they were domestically produced. The next item here is the Section 179 expense, which is the first year accelerated depreciation you're allowed. That's now been increased to $1 million that you can take a year. It used to be $500,000. And the phase out has also been increased. It used to be that if you bought more than $2.5 million of assets that you were expensing in the first year or taking accelerated depreciation on, there'd be a phase out in the lowering of, say, the $1 million. So that still exists, but the phase out period now starts at $2.5 million. So again, the theme is, once again, invest, and will allow you greater expenses to take against your income. The net operating loss deductions, that's now eliminated for corporations to 80% of your taxable income. So you can't take a net operating loss and not pay any taxes. So you're going to see less articles in the newspaper about corporations paying no taxes. They always want you to pay something. So it's now limited to 80%. You can't carry back, but you can carry forward now indefinitely. So a slight change to the net operating loss deduction there. Entertainment expenses. Maybe the #1 question we've received prior to this seminar or webinar about is, what about these entertainment expenses that are no longer deductible? Well, the good news is that you can still take your clients or customers to lunch and write off 50% of that lunch, but you can't take them to for a round of golf or to a football game or a basketball game and deduct that. Those are no longer deductible. But again, and then there's some special rules about if you have a food and beverage, which doesn't affect too many of our clients, but if you have a eating facility on your campus, about being able to even expense those those costs of having an eating facility on campus. So if you have that, you need to talk to your CPA or us, and we'll help you with working through that to make sure that you're getting a deduction you anticipate. The next item, kind of timely, is has to do with sexual harassment. In the past, the law allowed corporations to deduct their settlements or payouts to employees for sexual harassment or abuse. That is no longer the case if you have in your agreement a non-disclosure clause. And all of them will. I just can't see anybody settling without having a non-disclosure clause. There's just no incentive perhaps to settle. So I think one thing that I don't know that it's given much thought about here is I think corporations will only be offering smaller settlements perhaps because now they don't get to deduct. It's going to be 100% non-deductible. So it might, more cases may go to court because the settlement isn't high enough maybe for the victim to want to settle, and the corporations aren't going to want those non-disclosure settlements. So it's going to be interesting how that plays out in the employment law area. The second bullet point on this slide has to do with the family and medical leave provisions. You can now get a credit up to 12.5% of wages paid for employees who you allow to take a family and medical leave. And so that's nice. And to qualify, you have to pay 50% of the wages they normally would have received during their time off. And so it's a temporary credit, though. I'm not sure why, but it's just a temporary credit that you're allowed only for the tax years 2018 and 2019. Next item. Loans from qualified retirement plans. Here's a provision that a little bit helpful to the employees who haven't, who have maybe defaulted on their loan that they've taken from their own retirement plan, that they can have a little more time to pay that back. It used to be they only had 60 days if they were in default into their loan, or it had to be, you had to include it in your employee's income. Or at least notify the IRS, and then they'd have to pay an excise tax of 10%. So they now have longer to pay that back. They have until the time they have to file their tax return in the next year, which gives them a break and gives them more time to maybe get caught up on their loan. Then next we have the excessive employee compensation. And kudos to you if you're in this category. Like corporations that pay employees more than $1 million per year now are not going to be allowed to take a deduction for that excess. So it's going to be, you know, not going to be able to expense it. So just keep that in mind. Perhaps there might be some other workarounds that you can do. So maybe you can defer some compensation to those individuals in another way rather than paying the $1 million or more than $1 million in any one year. Qualified equity grants. I really don't want to spend too much time on qualified equity grants. The problem is here that it's very complicated. I think too complicated. There's been a lot of commentary already that it may not be that helpful. But there is a way that you can structure stock rights to employees and startups that they are allowed to defer a greater amount of the income once they cash out of the stock rights they have in the startup. So it needs a lot of planning if you're going to consider this, and we can help you work through this and structure a proper plan if need be. Now to some miscellaneous new provisions. This first one, I think Cindy mentioned it too. There's no longer this individual mandate. This is a big deal to the GOP who wanted to hopefully pare back Obamacare. They're hoping that less people sign up and there's less government subsidy and less expense to the federal government. I think if they eliminate the mandate, we'll see how that works out. And then I just have a few provisions I want to talk about tax exempt organizations here for just a short bit. The unrelated business income that tax exempt organizations have to pay when they start engaging in what are outside the realm of their charitable purpose. They used to, a lot of large charities had different trades or businesses, or do have different trades or businesses, and they used to offset income they made in one against their losses in another. Well, what the tax law is now is that you're going to have to define each trade or business, and you're not going to be able to offset your income that you have to pay tax on. So there are, I think, more charities, especially the large charities, are going to need to watch this, and they're going to be paying more tax on their unrelated business income. So that's a planning area that you need to start. If you're in that situation, you need to start doing some planning now about how to maybe try to keep your UBI to a minimum. And also charities similar to the charitable organizations, similar to the for-profit corporations, have an excess compensation limit of $1 million. But you know, since they don't pay taxes, they couldn't say, okay, you can't deduct this, because it didn't matter to them. They don't have taxable income in a charitable organization. So what they said was, if you're paying an executive over $1 million in a charitable organization for his salary, his or her salary, you're going to then pay 21% excise tax on everything over $1 million. So again, one way around this, a planning opportunity here is to maybe keep the taxable compensation to $1 million, and then give them some type of non-qualified deferred compensation plan benefits for any amounts over $1 million. And there's ways where you can subject that non-qualified retirement plan to substantial risk of forfeiture and not have it included in an individual's compensation that year. And the organization then would not have to pay the 21% excise tax. So that concludes my comments on the corporate business area. I want to say just a couple of things before we maybe get to a question or two. Is this the webinar slides and today's recorded presentation will be available on our website. And if you don't have a question today, but you have a question for any of us that presented today, just send us by email, and we'll be happy to try to answer your questions for you. I'm going to turn it back to Alex now for questions.
Yes, we've had some things come in, and please don't let us discourage you from submitting something if you had a question about what Denny was just talking about. We have had a few questions that we'd like to try to address. From what Cindy discussed, it's a question: if I refinance my mortgage for a lower rate, will the interest be tax deductible, or is it no longer deductible up to $750,000? Does the deductibility apply only to newly purchased homes? And I'll let Cindy address that.
Okay, that's a good question. For mortgages that existed prior to December 15th of 2017, they're grandfathered in. And the prior limit was $1 million. So if that mortgage is refinanced, the general rule is that it is deductible up to, even if it's higher than the $750,000. Let's say, well, but you can't, it's deductible up to the mortgage that you had in existence when you refinanced it. So if your grandfathered mortgage has a balance of, let's say, $900,000, and you go and you want to refinance it to $1 million, you won't be able to deduct the interest. And I think it would be the difference between the 900 that you currently had and the extra 100 that you take out. So you are limited. And the other matter is that this limitation only goes through the modified period. So it is going to go to $1 million mortgage again, starting in 2026.
Okay. A few other things that have come in. There's a question about whether the QBI deduction expires. Yes, that is one of the things that Congress put in place only during that modified period that lasts through the end of 2025. So that deduction will sunset after that time unless there's a future law change. There's a question about whether IT service firms may be characterized as one of these service firms that limit the deductibility of the QBI. You know, and knowing a little bit about the business that's probably being asked about, it does not appear from what we have now that a business that primarily involves the installation of products and perhaps some advising related to that is likely in that list of excluded businesses. We will know a lot more, however, when the regulations come out, and perhaps even there could be problems there. But technology is not one of the listed trades, and you know, in the case of a sale of products and installation, be really questionable whether that, you know, the principal asset of that trade or business would be the reputation or skill of its employees. So again, the regulations will provide more clarity, but it doesn't seem like that's directly in the addressed businesses. One more question that we had is the QBI deduction. Is QBI the net income from the pass-through entity, which would normally flow over to page 1 of the 1040? Here, we should say we don't, you know, there haven't been tax forms that have been introduced yet, and we don't have the regulations that will provide more clarity. I would say a qualified yes, in that the QBI is intended to be net, but there's going to be specific rules for how the QBI is calculated. So it'll really be that kind of calculation at a more granular level that tells you it's net of what. So I'm sorry to punt, but we don't have good regulations yet on that. I actually think that's all of the questions that we've received at this point. We thank everyone for your participation today with us in the webinar. Please don't hesitate to get in contact with us if you have questions, or if you want to look at your own individual or business planning as a result of anything that we've said. We thank you for joining us, and we hope to see you soon.
Thank you.